Chapter 10 handout, we'll start with that. And then monetary unit sampling will, second half of the class, we'll work on this. We might finish the chapter 10 handout tonight. I'm not sure. We'll see how it goes. Okay. So let's go ahead and not that. Yes, this. Okay. So we stopped at J, it looks like. What I want to do, I think we'll these two questions are for the bank confirmation and the cutoff bank statement. All right, so just to kind of refresh our memory. So the standard bank confirmation form, it doesn't have any transactions on it. There's no checks clearing, there's no deposits clearing, nothing like that. It's just the only thing it'll have on there, it'll have the ending balances of the accounts. The good thing about it, which by the way, you can get from the bank statement. So those two things are generally not that interesting. But it'll also have loans and loan agreements, and it'll also usually list what the terms are, what the collateral is, and all that kind of stuff. And why that's important is that a lot of times the loans will say things like, for instance, you can't have accounts payable of more than $1 million. Because the bank wants to protect themselves, and or they'll say that you can't get financing from anyone else in that loan agreement. And you have to watch it, because on the audit, you have to be very careful to see that if they are violating those, the loan agreement, because presumably the bank, when you do the audit, they're going to get a copy of the audited financial statements, and they'll be looking to see if it complies basically with what they have. So it could be, you have to be very careful about it, looking at the terms of the loans and things like that. But it doesn't have any transactions. It doesn't have any of the daily stuff. It just says, here's the balances. Here's the balance of the loan that's owed. Here's all, all the accounts, ending balances only. And the important thing is, a lot of times they'll have they should have anyways, the terms of the loan, what's pledged as collateral, and what is interest rates and all that kind of stuff.
As an auditor, are you responsible for making sure that they're following the terms of their loan?
Yes. It comes down to materiality, which is actually, we didn't cover this in chapter 6, but materiality is a dollar amount a lot of times, like we talked about, 2% of assets or whatever it is. But also, if it violates a loan agreement, it might be material, even if it's not, even if it's an immaterial amount. So for instance, let's say that they had, the loan said that they couldn't have more than $1 million of accounts payable. Let's say they have $1,006,000 of, accounts payable. But let's say that they cooked the books a little bit, and made it come in just under that $1 million. Even though the dollar amount might not be immaterial, if they changed it by $10,000 on $1 million, probably immaterial. But even though it's the dollar amount is material, it might be material because it actually violates that loan covenant. So yeah, you are aware of the contracts that are, and you're aware of the reader, and that they will probably be looking to see if it violates the contract. So yes, yeah, in the shorter version of my answer, yeah, you are responsible for looking to see if they violate contracts. Even an immaterial dollar amount might be material because of it. So yeah. And yeah, okay, so let's see here. Okay, so that relates to this here, which number 5. You guys probably have this on page, you might have this on page 4, I'm not sure. I'll fill this in later, the bank reconciliation. Which of the following can be verified by a standard bank confirmation?
B and D.
Yep, BD, actually even C. The ending balances we'll know. We won't know the daily stuff, but you will know the ending balance. Now, truthfully, the ending balance is probably, will be on the regular bank statement at year end. It should be the same number. But yeah, so you won't know that, but you will know the loan agreements, ending balances, and collateral pledged. And again, the loan agreements are something that you are responsible for, because whoever's going to be reading this is probably one of the people going to be reading the financial statement is going to be the bank. Now, having said that, if it violates the loan agreement, but if they put it on the books, that at the correct amount and that it's shown that it's in violation, there's not a problem. You're not responsible to call the bank and say, hey, look, they violated your loan agreement. It's not like that, but their financial statements must be, not materially misstated. And if they're violating a contract, even if it's an immaterial dollar amount, it's being misstated. Because it's saying that they have not violated the contract, and in fact they have. Okay, cutoff bank statement is made usually 1 or 2 weeks into the following year. And that is, it's there to catch a few things. And actually, if you come down here, which the following would be cut by a cutoff bank statement, it's actually going to be all of these. Deposits in transit. If they made a deposit at the end of the month, it should be in the bank by that time. Unrecorded liabilities. I don't know if we talked about this or not. Unrecorded liabilities. Items paid in early January. Maybe it's likely, anyways, that they would be relate to the previous year. And what could be happening is they don't put it on the books. They get the phone bill. Instead of recording the phone bill and then accounts payable, they don't put it on the books at all. But they're still going to pay it when it's due. So in January, when it's due, they pay it. Well, again, so anything that's paid in January that it wasn't on the books in December is a little bit unusual. Now, it could be, it could be everything's fine. It could be, they paid cash for something, but it also could be that they have unrecorded liabilities. They had things, something that they owed that they didn't put on the books. And it would also, not only would they not have the liability, they wouldn't have the expense. So yeah, it'll catch those things too. So anything that's paid in early January oftentimes relates to December. So if it's not on the books in December, you have to look into it to see what it is. And kiting, we'll talk about that today later on. Kiting is when you make it look like you have more cash than you actually have. It's not so popular anymore, but still can happen. Okay, bank reconciliation. This is what we're going to spend some time on today. This ooh, no, that's not gonna work. Okay, a bank reconciliation used to reconcile the book balance for cash with ending balance bank statement. And a bank reconciliation is basically there for to make sure that you find the correct balance. So you look for the corrected balance of the bank statement. Okay, well, we are going to do some bank reconciliations today. So we'll do L. Now, basically, you're going to be doing corrections to two different sides. There are some things that we know that the bank doesn't know. Right? So, for instance, if you write a check and mail it out, the bank's not going to find out about that for a while. We know we wrote the check, the bank doesn't know. There's things that the bank knows that we don't know, and usually we find out those things on the bank statement. So those things that show up on the bank statement are things that usually we don't know about. And if you think about it, if you think about it in terms of say writing checks, there are things that we write checks for, right? That we know we wrote the check, but there's some things like bank fees. You don't write a check for a bank fee. The bank automatically takes it out of your account. There's no check written for it. So you don't find out about the bank fee until you get the bank statement. So there's things that we know that the bank doesn't know. And there's things that the bank knows that we don't know, and those are usually those things that are on the bank statement. So if it's on the bank statement, usually those are things that, and we didn't write a check for it or anything like that, then it's something we have to put on the books. Okay, so we start out with our balances. So I'm coming up here. I want to bold these so we can see them a little better. Okay, so we have a bank balance of 2,400. And our book balance is 1,950. And those two are not equal. So we have to make some corrections to the sides here. And now down here at the bottom, I'm going to come up with a corrected balance. And they should be equal at the bottom. These two sides are going to be equal. Okay. So we're going to take these items through here and say, okay, which side do they go on? And are they pluses or minuses? Okay, deposits in transit. These are deposits that were made at the end of the month. And when you make a deposit in the bank, does it immediately go into your account?
No, processes for a few days.
Yeah, usually a process, especially if there's checks and things like that that they would. So a lot of times you make the deposit and it doesn't show up on your bank statement. They don't show it in your bank balance because it hasn't, the deposits haven't cleared yet. So you made the deposit. The bank just doesn't know. So whose side are we going to correct? Our side, the book side, or the bank side?
The bank side.
Bank side. Plus or minus, do you think? These are deposits.
It would be plus.
Yep. Okay, EFT payments. EFT is, oops, you guys probably already know this. Oh, my keyboard's not. What am I doing here? Oh, it's some weird thing I got. EFT stands for electronic funds transfer. In other words, no check is written. So there's no check written. Let's take the EFT, let's say a payment of rent. So whose side are we going to correct with this? The book or the bank? Now remember, we didn't write a check for this, so there's no check written. There's going to be a check in our check register for it. Where are we going to find out about this? Probably when we get the bank statement.
So it'd be a book balance subtraction.
Yes. So the EFT payment. Oops. 120. Well, an unrealistic rent payment, but okay. I guess it depends on what they're renting. And EFT receipts, same thing, right?
But to add.
Yep, good. NSF check. Now this is a customer's check. So a customer gave us a check. And we took it, we thought it was good. We was put in with our deposits. But it comes back that it's NSF, which is non-sufficient funds. All right, what are we gonna do with that? So we,
Subtract on the book balance.
yes, because there's 240 in this 1950 that really isn't there. We made the deposit, we thought it was good. Made the deposit, find out that it isn't, so we have to take it out. $240. I'm gonna be making check marks by these or something as we go. Okay. Oh, outstanding checks. These are checks that are written, but they haven't cleared the bank yet.
So it increased the book balance.
Yeah, so well, they're going to, yeah, they're going to,
You're gonna decrease the bank.
yeah, yeah, so here's the thing, we've already taken this out of our book balance. So we've written these checks and put them in the mail. It's kind of like, you know, you print the checks, put them in the mail, you mail to somebody. Now, we know we wrote these checks. The bank has no idea though, because they haven't hit the bank yet. So we have to correct the bank side. They don't know whether we wrote these checks because there's a, you know, a delay in it. So this will be standing. You know what I know what I'll do. I'll make these a different color. This will be turquoise. This will be turquoise. So outstanding checks, and these are very common. The two common ones: deposits in transit and how you spell outstanding. How you spell either. So we wrote these $800 in checks that the bank doesn't know about. Okay, bank fees.
Subtract from the book.
Yep. Yeah, there's not gonna be a check written for that. They're just gonna take it out, so you'll see it on the bank statement now, how much bank fees they've taken out. Okay, now the kind of wacky one that I'm not sure how often this happens, but anyway, you see it a lot of times in bank reconciliations, and you see it on the CPA exam too. A note collection. What is a note? A note is sort of like a post-dated check. It's and similar to a check, it's a, you know, if you sign a check, whatever you have written on that check says, you know, that legally whoever has that check, they can take that money out of your account. Same thing with a note. It's a legal claim on that money. It's generally made for some time in the future, in 90 days or whatever like that. So you have a note in 90 days, and oftentimes, unlike a check, it will have interest on it. So they'll say, okay, it'll be 3% interest for 90 days. And when they pay it off, they'll pay the interest too. Now, because it's very similar to a check, a lot of times if you have a note there, or you can anyways, have the bank collect it for you. So the bank will collect the note from whoever wrote it. You know, again, it's a legal document that they've signed and said they're going to pay X amount of dollars in however many days. So the bank will collect it because it's similar to a, it's a financial instrument. It's similar to what a check is. Now they usually charge you a fee or something for it, to collect it. But anyway, so if you have a bicycle shop and somebody comes in and gives you a note, you can take it. Say, okay, I know this is kind of like a check. I'll take it, but I'm not really in the business of collecting notes. So you give it to the bank who have a little more experience doing that. I make bicycles. Okay, so when they collect this note for you, where's it going to go?
Add to the book balance.
Yep. So note collection plus 500 and interest income.
Increase the bank balance.
It's probably already included in the bank balance.
Oh, okay, then it may increase the book balance.
Yeah, because you'll probably find out about it on the bank statement. Okay, so that's everything, right? Not a bad idea to count them sometimes. 1, 2, 3, Okay. That's I have a little too many rows here. I'm gonna. All right, so look at a corrected balance for each one, and they should be the same. $15. And hopefully we will get the same thing over here.
It was the same when I did it.
Same.
Same for me too.
Same thing for me. So this is the corrected balance. So that's the true amount of cash that you have. Now, one of the, since you have 1950 sitting in your account, you're going to make journal entries for all of these to bring your cash account to this. So one of the reasons we do bank reconciliation is to make sure that we do the journal entries that will give us this corrected balance. So for instance, EFT, the revenue one, it would look like this. Don't do that, Mark. So the journal entry for this one would be cash, 50. And you make the journal entry for note collection. This would be cash. 500. And notes receivable will be going down by 500. So you go through each one of these and make the journal entries for them. Go through them. I may as well just do them. And so this would be oops. So that would be for the pluses, and I'll do the minuses over here. So this would be rent payment. So this would be, oops. This check would be an interesting one. You probably wouldn't forget about it. You would probably say accounts receivable because you're probably going to call them up and say, hey, this check's no good. Come in and buy it. And if they don't, you can turn it over to the state, then the state will multiply it by 3 and then go after them for it. And what's the last one for bank fees? Okay, so probably bank fee expense or something along those lines. So you'd enter all these from this up here. So, you know, one of the reasons why we do it isn't just to make sure everything's on the up and up, but also to make these adjustments to our books. So if they don't do a bank reconciliation, more than likely their books are going to be off. Now, I don't know if they'll be materially misstated, but they will certainly be off because, you know, they won't have the adjustments that they need to make in it. Any question on this? Now, there are some things that the bank, you know, that the doing a bank reconciliation will find. For instance, let's say that I get my check and it's $600, and I say, well, I'm worth a lot more than $600, so I put a 1 in front of it and make it $1,600. That's more like it. And I cash it for $1,600. It'll come out in the bank statement or the bank, excuse me, bank reconciliation. So the bank reconciliation was going to come on the, wait a minute, these guys don't balance, they're off by $1,000. You know, then they'll start looking into the things that go in the bank statement, and you know, once they find what it is, then they'll probably fire me. But anyway, but you can find things like that on bank reconciliations. And also, you know, suppose somebody, you know, the business has their checkbook. Someone decides they're going to steal checks and write the checks to themselves, you know, or to cash or something like that. If they're complete idiots, they take it off the top, which, you know, but let's assume they're not complete idiots because they're, you know, they're sequentially numbered and they start out with the checks. Hey, what happened to you? So hopefully they'll take it off the bottom if they have any kind of common sense. You'd be surprised what crooks do, but anyway, and cash those checks. So that would also come out in the bank statement because there'd be a mismatch for that bank, you know, the amounts that are in there. So the corrected balance when equal. Now, for things like forged signatures on checks, the bank is responsible for that. If it's a business, though, they're only responsible for the first month's worth because it should have come out in a bank reconciliation. A bank reconciliation is considered a basic business control. And so the first month they're responsible for. If it's something that would have been caught by doing a bank reconciliation, they're not responsible for it after the first month. So you find somebody that's been writing bad checks from the business for 2 years. The first month they wrote it, it's on the bank. The rest of it is on the business. So it's not just an accounting thing, but it's also just a good thing to do, bank reconciliation. Okay. Question on that? All right, now we come to the CPA exam bank reconciliation. This has appeared on, I believe, basically in its basic form, it's appeared on 2 CPA exams. And they give you this information. This is from the bank reconciliation from the previous month. The deposits in transit, the outstanding checks, there's a balance per books. This is also, you know, the corrected balance. Oops. So these are the deposits in transit and the outstanding checks from March. And now we go into April. And one of the things we have to find are the deposits in transit and the outstanding checks. So that's what we're going to do first, and then we'll go do the bank reconciliation. All right. So I should maybe make April a different color. Let's make April green. How about? So notice that those deposits in transit and the outstanding checks from March, those should be hitting the bank in April. So the checks and the bank and the deposit the bank receives in April, some of those will be from the previous month. Right, does that make sense? That those outstanding, the deposit in transit and the outstanding checks, that those two amounts, those two groups should be collected in the following month. You know, if you wrote checks, whoever got the check, they cashed it, it should be in there by the next month. Okay, so the question is, we know what the new checks we wrote for April are, plus we have these outstanding checks for March. Right. Oh, I'm sorry, let's do deposits first. Sorry about that. So here's the deposits. So let's do deposit. Checks are gonna be very similar to this. Okay, so deposits in transit. Now, the bank has collected 8,700 in deposits in transit. Now notice how much in deposits in transit we've actually have out there. We have 3,500 from March. I'm sorry. Class today, Mr. Taylor doesn't know how to use a computer. Okay, and then the April check deposits are 8,400. So the total number of deposits we should be getting, or that are out there, are whatever those two are together. 500, 400. 11,900. So if they would have collected all the deposits that we made, there'd be 3,500 from the previous month, plus the 8,400 from the current month. So they would have collected 11,900. So this is the total amount that they should have collected for the deposits if they collected everything. This is how much they collected. So how much of the deposits are in transit? Question only answer. I know the answer. So how much of the deposits are still in transit? If they would have collected everything, they would have collected the deposits from March that they didn't collect yet, and our new ones from April. So this is the total amount. If I can squeeze that in here. Probably not. Put it underneath here.
So they're missing 3,200.
Yes. So we'll compare it to what the bank has. The bank said they collected 87. So so the total that is still in transit is 3,200. That makes sense?
Yes.
Okay, let's go to the outstanding checks. We'll make this yellow. So we had 4,500 of outstanding checks from the previous month that we wrote that the bank hadn't collected. We wrote an additional 9,200. So if the bank would have collected, or paid out basically all of our checks, it would have been wherever that is. That 13,700. Okay, so the bank collected 9,100. That 4,800. No, 4,600, right? Okay, I'm already Mr. Calculator. So 13,700. The bank collected 9,100. Okay, so these will be the outstanding checks. So it's basically what's the total, the total checks, deposits for that didn't hit the bank yet from the previous month, along with the new ones. And then the same thing with the checks. The checks the bank didn't know about, plus the new ones we wrote. And then we'll find out what how much is still either in transit or outstanding. Question on that? And so this is what we would put for our deposits in transit. 3,200. And 4,600 for the outstanding checks. I don't know why I made this so big, those spaces. Okay, so going on to the next page. So we got the outstanding checks. So we're gonna do the bank reconciliation. I definitely gotta I think it'd be a better way to do this. All right. So let's take a look here. So we have let's see, the bank balance was. I'm gonna try to get these closer together. Can't do it. Okay, so the balance for bank is 27,140, so this would be 27,140. And the balance per book was 23,800. And we may as well do the deposits in transit and outstanding checks. Okay, so that takes care of those two. Now up here, we still have to go through these. So the bank said they collected a $2,500 note for us. They have a service charge of 60 and an NSF check of 500. Okay, so the note collected, where will that go? Bank or book?
Book.
Book. Service charge. And you can actually kind of see here, you know, if this is coming from the bank and it's not on our books, these are all going to be on the books, right? So service charge of 60 and an NSF check of 500.
Yeah, both would be subtracted.
Yep. Just that quick, I forgot what it was, 60. And the NSF check. And so there's a corrected balance. Some number. All right. Oh, by the way, on the test, you're going to get one of these. $5,740. Hopefully, it's the same thing over here. Oops. So you want these two sides to equal, and they do. That's it. I think I'm gonna give you guys this next one's exactly the same, or you know, has different numbers, obviously. And I'm gonna assign this for homework for next week.
Okay.
Next week is spring break. Should it be due in 2 weeks then?
What? Is it? Why spring break is so early? Yes, like I was saying, next week is spring break, so this will be done in 2 weeks. So what is it, week, what is this, week 7? So that'll be week 9. Okay. Thank you for telling me that. Yeah. Okay. So, yeah, so anyway, it's very similar to the one we just did. Yeah, it's basically the same. And by the way, my reason for putting it on here and for testing on it is that you'll actually, it's possible you'll run into this in 2 different spots. You can run into bank reconciliation in the auditing section. And you can also run into it on the financial accounting and regulation. You find it on both of those. So it's one of those topics that, you know, you can find on both. You know, most of the stuff in here you only find on the auditing section, but this is one you actually could find on the financial accounting and regulation, and it's a really important one. So it wouldn't be it'd be likely that at least likely that it would be on in some form on one of those. Okay, so let's go ahead and take a break, and we'll come back. We'll do the monetary unit sampling. Second, we already worked on this, I think. Yep, we did. Okay. And I think we're on this page, I think. Okay, so we'll say be back at let's say 7:05. Oops. Okay. Okay. Metro unit sampling, and you recall, kind of going back to beginning here. The idea behind monetary unit sampling was that we'd have this interval. So we have these intervals that we would pick one item, it would represent that entire interval. And we do sort of like a ratio estimation. We take a ratio of the audit to the book, and that would tell us what the projected value is, and maybe more importantly, what the projected misstatement is. So as we go through here, so this interval was always what we'd look at as far as taking one item and multiplying it by it. Now we're going to kind of go through a few more rules about this kind of this process here, about it, how we get this projected misstatement. It's a little bit wacky, but the basic rules. Incremental allowance. So incremental allowance is the idea behind incremental allowance is that if you do find errors in an interval, if the item you pick is less than the interval, like up here, let's go up here. It's fun one. Okay, like let's say this one. If the item you pick is less than the interval, that tells you that there might be more errors in that interval, right? Because you only picked this one, you pick 750, the interval. Because there's an error, it means the possibility has increased that there could be errors. And in that interval itself, there could be higher errors. So the whole idea behind incremental allowance is the more errors you have, the more likely it is that you have errors. Right? I mean, if you don't have any errors, then the likelihood it won't be any greater. But if you do have errors, it's okay. We now know that there are errors, and in any of these intervals that there are, that there could be additional errors in those intervals. So that's kind of what the incremental allowance is all about. It's like, things could get worse, especially in that interval. Right. So, in the interval itself, things could be worse if the item that you picked is less than the interval. Okay. I don't know why I put it in this order. I put it in this order because the book did, but the second quirky thing is that the monetary unit sampling is only used to detect overstatements. Understatements are ignored. So when you find an understatement, you ignore it. There is no misstatement. And as an auditor, it kind of bugs you a little bit because you think, okay, well, wait a minute, this is wrong. Well, it's an understatement. It's not supposed to catch them. It's sort of like if you were going fishing and you're trying to catch fish and you reel in a boot. Well, you don't want it because you're trying to get fish, so you would. Well, don't throw it back in, but yeah. Anyway, the boot wouldn't mean anything. You throw it in the garbage can. Same thing here. If it is an understatement, this method is not supposed to catch those. You throw it in the garbage can. There is no misstatement. And probably the quirkiest one of them all. If a misstatement item has a book value that is equal to or larger than the interval, then the misstatement is the difference between the book value and the audit value, and these are not included in the incremental allowance. There's a whole bunch there that probably doesn't make a lot of sense. Okay, so if the item that's picked is bigger than the interval, So if the interval is say 1,000 and the item you pick is 1,200, it's bigger than the interval. So it's 100% sure it's going to get picked. However, notice that nothing else could be wrong in that interval. It takes up the entire interval. So it won't be in the incremental allowance. That interval could not get any worse. It's misstated, but it couldn't get any worse. So if the item is picked and it's only if the book value is larger than the interval, then we take the actual misstatement for it. We don't have a projected misstatement, it's actually the actual misstatement, and is not included in the incremental allowance. Right? It's probably confusing, so I think what maybe we should do is do a few of these and see, kind of see how they work out. The first three here are pretty much what we've been doing. So these first three should be kind of a little bit of a review. Okay. Oh yeah, so yeah. So let's go ahead and do the first. This will be a little bit of a refresher for these. We do the audit divided by the book. Oops. Times the interval will give us the projected. Oops. Okay. So 14,000 divided by 20,000. Times 40,000. It's 28,000. Okay, so the projected value for this one would be 28,000. And the projected misstatement would be how much? What would the projected misstatement be? Anyone? Projected value is this. So the $40,000 interval, we're saying it's really only worth 28,000. So projected misstatement would be, oh come on, you guys are toying with me.
12,000.
Yeah. Now, things could be worse because you notice that this book value only covers 20,000 of the $40,000 interval. And because there's an error, it makes it more likely that there are errors. So it's likely this could be worse than we have here. So is included in the incremental allowance. My spacing here is not very good. Yes. And the incremental allowance we'll get to later. I actually calculated it. Okay. And we do the same thing here. So 2,400 divided by 3,000. And included, yeah, because this one's only for 3,000. Just probably a different color. You know, and like this one, it's less than the interval, so there could be still more things that are wrong. So it is included in incremental allowance. Oops. Zero, divide by, doesn't matter, it's 0. So the projected value of this one will be 0. Projected misstatement is 40,000. And it's included because it could go, even more things could be wrong, right? This one takes up 1,700 of the interval. There's another, whatever, 38,300 stuff that could go wrong. So is it included in the incremental allowance? Yes. So these are kind of the same as we, similar to what you had in the first page. Okay, now for the wacky ones. What is strange about number 4? Or different than the other ones?
The audit value is bigger than the book value.
Yep, this is an understatement. Because it's an understatement, we ignore it. So this will just be everything's fine. Oops, that's not fine. And the projected misstatement is 0. Is it included? No. We find out that even if it was, it wouldn't make any difference because the error is 0. So this is an understatement. And whenever you have an understatement, it just says everything is okay. And again, as an auditor, when you look at this, you say, hey, wait a minute. That doesn't seem right, but that is right for this method. So when you do find an understatement, it just says, okay, it's not misstated, because it's only looking for overstatements. So number 4 really isn't an exception at all. It's everything is fine. Okay, now let's look at the wacky ones here. 5 and 6 are wacky. And they're wacky because of this. Let's take this one. The book value for this item is larger than the interval. So notice there's a 100% chance this item is going to get picked. It has to, right? It's larger than the interval. It'll cross one interval. It may even cross 2 intervals, but it's 100% sure that it's going to get picked. Now there is a little bit of a quirky thing though, if you think about it. It's larger than the interval. Normally when we think of sampling, you take something small and project it over the larger population, right? And you'll notice that the other ones up here, we've taken something, where 20,000 projected it over the entire interval of 40. We take some of the 3,000, projected it over the entire 1,700, we projected it over the entire. This one is kind of the opposite. This is something really big that we're going to project over a smaller interval. If we were to multiply this thing out, I'm going to do it two different ways. I'm going to show you how to do it wrong. And then I'll show you how you do it the correct way. So the first way will be the wrong way. A logical question is, do we have to do this? Well, no, you don't. I just want to demonstrate why this would be wrong. Okay, so this is going to be the wrong one. Okay, the wrong way would be, okay, let's just do it the same way we do the other ones. 11,000 divided by 44,000 times 40,000 equals 11 by 40, what was that, 25? I think it's coming up to 10,000. In which case we would say that the misstatement would be 30,000. Now notice something here. For this item, what is the actual misstatement?
$33,000.
Exactly. This reduced the misstatement. If we multiply this out, it's going to reduce the misstatement. We're not going to put 30,000. We know this thing is misstated by 33,000. So we're not going to do it this way. What we're going to do instead, when this is greater than the interval, we're simply going to take the actual misstatement. Which is 44,000 minus 11,000. And so this is what we're going to put in for our misstatement. So the projected misstatement in this case is it's a little bit of a bad term for it, because this is not actually the projected misstatement. This is the actual misstatement. But if it's larger than the interval, you're going to use the actual amount. Because again, this one is misstated by 33,000, not 30. It would be sort of like taking the opposite. Instead of taking a sample and making it larger, it'd be like taking a sample and squeezing it down into 40,000 rather than 44,000. This is not included in the incremental. It couldn't get any worse. It covers the entire interval. So because it covers an entire interval, it cannot get any worse. It's not included in the incremental. Because that portion, that interval, that portion of it can't get any worse. And I know it's kind of a weird thing to think about. And so we'll do the same thing down here. This is larger than that. So we are going to, oh, by the way, this one cover at least two. At least two. Actually, one to three intervals may be crossed by this one. Am I saying that correctly? I think so. Yeah. Well, like, no, it has to cross at least two. It could be for two or three, actually. Okay, so anyway, regardless, we're gonna do the actual. And again, it could not get any worse. If it's larger than the interval, there is no incremental allowance. So these up here, they could have more errors in them. These down here cannot. Because they cover the entire interval. Now, the last one covers at least two intervals. Okay, so we will add all these, well, all of these will get added up for the projected misstatement. I don't know what I'm doing here. So 12 plus 8 plus 40 plus 33 plus 25, whatever that comes up to.
At 118,000.
118? Okay. So that is our projected misstatement. All these together, 12 plus the 8 plus the 40 plus not that one. I'm going to take this one out because it's wrong. Probably take this one out too if you want it. But the yeah, so those are, yeah, so that's 60. Yeah. 18. So this is the projected misstatement. And the estimated balance is, well, it's on the books at 800,000. So the best estimate of accounts receivable balance is what? So the book value is 800,000. And we're saying the projected misstatement is 118. Six. It's late, it's Thursday. I'm gonna use the calculator. $682,000. So this would be our best estimate of accounts receivable balance. Okay, we're going to get started on this next one, but we're only going to do the part that we just did. First of all, any questions on this up here? So this is the best estimate of what we think that it's going to be off by 118,000. So we're saying, look, our best estimate is this is really worth 682,000. Okay, let's do these first three here. We'll do these first three here and then we'll call it a day. We're not going to do the rest of this. We're just going to do this, find the projected misstatement for this item. We'll get these other ones when we come back in 2 weeks. So see if you can figure out these first three here. What did I do wrong?
You're not supposed to do the actual, you're supposed to use the the interval because it's larger. Audit is larger.
Yeah, this one is actually one that we're not supposed to find. This is an understatement. So because this is an understatement, we don't do anything with it. That's how you spell understatement. It's not even close to how you spell understatement. So this is an understatement. So we actually don't do any of this for it. This is not a misstatement at all. Oops. We don't do anything with that. So it's an understatement. We ignore it. And again, that auditor part of you says, oh, wait a minute, we can't just ignore it. It's wrong. You say, well, no, that's not what we're looking for. So this is an understatement. We actually don't do anything with it. Because this is bigger. The audit value is bigger than the book value. the book value is understated. So we say, okay, that's fine. It's really not an error at all. It's not a misstatement as far as the monetary units. Okay, now for these up here, if the book value is less than the interval, we put it in the incremental allowance because more things could go wrong, right? This one takes up 10,000 of the interval. Because there's an error here, it's more likely that there are errors. And in that interval, more things could go wrong. So this would be included in the allowance, incremental allowance. And same thing with this one. This one takes up 4,000 of the 50,000. So there's still another, whatever, 46,000 left. So these two will be an incremental allowance. This one isn't in incremental allowance. It wouldn't matter anyways because we multiply the misstatement by a certain number. It would be 0. So understatements, we don't do anything with them. This method is not supposed to find them. And when we do find them, we say we don't care. We don't say because we have bad attitude. This is the way the method is. Okay, any question on that? Well, if there are no questions, oh wait, we didn't do the protected misstatement. Protected misstatement is 40,000. So this is our best estimate is what these books are off by. So if this is 6 million, the best estimate is that this is 6 million minus 40,000, whatever that is. That would be our best estimate of what the books are misstated by. We'll do these other two. We come back in 2 weeks. Well, we have nothing to turn in. So enjoy your enjoy your break. There's nothing to turn in. We aren't done with this handout and we're not done with the other one either. So very good. We'll walk away clean. Any questions? Okay, well, I'll see you guys in 2 weeks.